Okay, welcome to this YouTube channel once again. So in this video we'll be talking about the ICT concept and then supply and demand. We'll be looking at talking about certain structures in the market. We're talking about the change of character in the market, the break of structure, and also how to mark valid structure points. Then we'll be looking at other blocks, the supply and demand. We're talking about breaker blocks, and also a type of sponsorship candle that Mansouri Sapari calls the double Marabuzu candlestick. So before we head back to the charts to really look at what we have for the day, I'd like us to check out something here. This analysis was conducted on the 23rd of January 2022. So you can see here it was an analysis I done and then marked it up as a case study for myself for educational purpose. And then I saw that there is a liquidity to be grabbed here, meaning I wanted to see price come to the upside here, grab this liquidity and then drop down. Within this zone there is a strong supplier zone here when we drop to the daily time frame. So when we get to the chart, you get to understand all of this. Price came here and then we start seeing price dropping. When you go back to the chart, you can see it. Though I wasn't expecting price to come with this at this moment of coming to grab this liquidity, but I think that was what price did. What I was looking at was price to come to this zone and then start dropping down, but price came, wicked this place and then started dropping to the downside. And then I want to show us how this markup study helped in me securing a lot of entries in VIX 75. You can see this was an entry in my pending order here, buy limit, sell limit, sell limit. Price came, activated the buy limit. That's it, a snapple entry, activated the sell limit. You can see how detailed view of the markets led to getting high probable trade setups. So we'll be looking at a lot of things in the markets. So I would like us to really pay attention because I believe this is a content you won't find anywhere. So this image will be made available to in the Telegram channel, so you can do well to follow the link in the description box and then get this image in the Telegram channel. So I think there was this Wyckoff also I looked at, but I won't really talk about it in this video. This Wyckoff I was looking at, and then how price really, I was looking at it respecting from this zone and then going to the upside. Though it came here, price dropped to mitigate daily breaker and fair value gap, a second area of interest I had in view. Though I really didn't consider this, I was more of like considering here, believing this was a liquidity for price to grab, but price dropped down to this place. So now I would want us to understand what market structure entails, knowing that market structure is actually the very basis for every technical analysis trading, and that market structure basically is made up of swing points, where in the case of you're having an uptrend market, meaning a bullish market, you're having a market making series of higher highs and higher lows, higher highs and higher lows, breaking this swing point. This is an expansion, this is a retracement, an expansion breaking this swing point, retracement, expansion, broke this swing point, created a new higher high, and then this is a downtrend making series of lower highs and then lower lows, breaking previous lower lows, breaking previous lower lows. A ranging market is basically reacting and supports and resistance, not really creating structure points. Then you have what we call the break of structure. When an expansion breaks a previous swing point, an expansion, retracement, expansion, retracement, expansion, retracement, expansion. And then change of character is actually a reversal price movement or action in the market, and it leads to the change in trend. You can see this the break of structure occurs in a trend, while the change of character leads to a change in trend, a reversal in price movement. You can see the market has been bullish. Once price broke the last higher high that printed, the higher low that printed this higher high, price started dropping and then changed character to bearish market. You can see the price has been bearish here, and then price moved to the upside, broke the last previous higher low, price turned bullish. So we'll be looking at market structure. So let's bring out the structure of this case study we'll be handling tonight. So we have from here to here, we have our expansion here, and then we see price retraced, price created another expansion, price retraced again to the downside, and we see price create another expansion, and then we see price again dropped to the downside. We see price create another expansion, and then we see price drop down to the downside, and then we see price move to the upside, and then we find what price drop down to this place, and then we see price again push to the upside. So you can see price breaking previous structure point, breaking previous structure point, breaking previous structure point, breaking previous swing points, and then now you can see price making words an expansion retracement, making series of higher highs. Now we can see that price have been forming this here. This is your high, sorry, you have your high here, you have this one, you have it here, 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 and then you have it here. Now I won't consider this as a higher low. I would consider this as a liquidity, an inducement. You can see price broke structure, retrace, broke structure, retrace, broke structure, retrace, broke structure, retrace. But this price didn't really retrace back into the demand block that broke that structure point. So this one should be an inducement, should be regarded as an inducement, because this is the other block, the demand block that broke this structure here, that broke the structure point here, and price didn't really retrace to it, to the demand block, to the OB that broke the structure point here. So this is our high, our low, our higher high, higher low, higher high, higher low, higher high. So this one too, it's not to be considered as our higher high, so I would remove this, meaning that this entire move here is now our higher high. It is now our higher high, and then this our higher low, and then price move to the upside. Now let me explain that, what we understand by this concept of liquidity. Now you can see that liquidity is actually, now let me say a car needs a fuel for it to move, so also the market needs liquidity for price to move in the market. So basically liquidity is the zone of stacked retail orders. So, and there are different liquidities. We have the external liquidities, we have the internal liquidities. So I won't really talk about this liquidities in details in this video. We'll create a separate video for that. So we've been, as retail traders, we've been taught to trade the W pattern, the M pattern, double bottom, double top, head and shoulder. These actually are liquidity pools. The institutions and hedge fund know about this trading strategy, so they use that against us to raid our stop losses. You can see this is a double bottom, right, believed to be a strong support, meaning retail traders will place their entry here and then their stop loss below the double bottom. But you would see what the institutions will do is this: they will come raid those double lows and then push price in the opposite direction, the intended direction that even the retail traders are looking on to. You can see what they would do. They would come, raid it, and then push price to the downside. You can see this concept here. This moved, this what broke structure here, came back down. This is actually a liquidity pool because it didn't really retrace back fully into the demand that broke what? The structure. That is what happened here in this scenario. You can see price here broke to the upside. Now what it did here, it created an inducement here. This price didn't really drop to the demand that broke the structure. It was this hook that came back and then tested it and then moved to the upside. So that is why you can see these images will be made available in the Telegram channel, so you do also follow the link in the description box so that you can get them. So you can see here we have a double high and then a double low. Price came, raided this double lows, came back to the upside, raided this equal highs, and then what? Dropped to the downside. Now this concept of break and retest is good. It's a lot of retail traders trade the break and retest, and I've made money from it. It is not wrong, but it is not really effective and highly probable setup to trade. You can see in a case whereby price will come to the downside, go back up, now break here, retest, and then start dropping. You can see price at the point of break of retest, it regarded it as an inducement and still went back up, read liquidity, and then dropped to the downside. So now you can see this, you can call it a break and retest because here is a break, price dropped down, retraced the break, but still what? Price dropped to the downside, and then to really mitigate this candle and then push price to the upside. Are we together? Because you can also see you have a fair value gap here. So this is the concept of trying to understand valid structure points. You must understand the concept of inducement also. So this is basically what we're trying to say. Now you can see price coming like this, and then dropping down like this, and then going to the upside, dropping down, and then going to the upside. Now you can see this actually is your main structure points, and then this, then this, then this, now this is a price move. This actually acts as liquidity because it didn't really return back into the demand zone. Then price went back up, meaning from here to here, this is your low, this becomes your high. Price now dropped into the demand, raided this liquidity, this becomes your lower, your higher low, give you another what? This is not your structure points as a higher high. This becomes your higher high because this sponsored the move that raided this liquidity to return back to the demand that broke the structure points. Are we together? So we must understand the concept of liquidity. You can see some people trading something like this, where you have price going like this, coming like this, then price came, broke structure here, came back to retest here, move to the upside, and then you see price still drop down to this place. Okay, this is it. You see price move to the upside, drop down, come to the upside, and then price return here, retest the break of structure, price move again, then you see price drop down to this place and then move to the upside. Now this is what's break and retest, right? It broke structure, retested structure. Now but price will drop down to the downside to this zone here, where words the order block that sponsored the break of structure lies. This is now regarded as a liquidity, and then price will come down to this point and then push price to the upside. Or you can find in a scenario where price comes, do something like this, come back down, do something like this, come, do something like this, come, do something like this, come, do something like this, then drop to this downside and then move to the upside, now creating more of like a trend line for you. And then you feel okay, price should come, respect this trend line and push to the upside, not knowing that price is trying to come down to the demand zone printed here, that this price didn't really mitigate, and then push price to the upside. So let's get back to the chart. So let me wipe off this. So now we've seen the structural part of it. Now you can see when price broke it, price came, mitigated this place. This is what Mansuri will call the double Marabuzu candlestick, which when you drop down to a lower time frame, let's see, you find that price will create a rally base rally. So you can see price came to this base point, reacted to it, and then pushed price to the upside. In this concept where we say that we'll find a scenario from where price move to the upside, a rally, comes down, a base, a rally, and then price drops down and then push price to the upside. Broke structure, price return, mitigate the OB that broke structure here, and then price move to the what, upside. So you can see this is it, a rally, a base, a rally, price return to mitigate the base points, and then price move to the upside. So that is what we can see happening here, which I believe should be in confluence with the Fibonacci optimum trade entry, you see, which is what within the 618 fib level, and then price pushed to the upside. Now you can see price broke this level here. You can see we have a fair value gap here, an imbalance in price action, meaning a sharp move that leaves price, that leaves a space in price. You see, this week didn't really close the space in price, so this is a fair value gap. You can see price came into it in confluence to a breaker block. This is now the breaker block, in confluence to a breaker block. A breaker block is a block that grabs liquidity. That is what a breaker block. Let's look at what I mean by a breaker block. Let's say you have price coming to the downside. Let's say you have your price coming to the downside like this, like this, like this. Price then comes, raid that lower low, return, break that structure there, come back and then push to the upside. Now your breakout block is here, because you find it is the candle that sponsored the move to the downside that raided this low, so your breakout blocks grabs liquidity. So we can see here, this candle grabbed this liquidity here, grabbed this liquidity here. You can see it cleared that equal lows here, it cleared the equal lows here, and then price moved to the upside. This breaker block came, sponsored the move that grabbed this liquidities here, and then price went to the upside, came back to retest the breaker block. So price continued moving to the upside after retesting the breaker block, and then price broke structure again here to the upside. Price broke structure to the upside. So, and then you have your double marabuzu candlestick here. There are two types of the double marabuzu candlestick, where you can have equal wicks or 1 wick engulf the other candle. So this is also a double marabuzu candlestick, which you can find a rally, a base, and a rally on a lower time frame. Let's check on the H6 time frame what we are likely to find here. So where should that be? Sorry. So you can see it here. You have a rally, a base, and then a rally to the upside. So let's check it on H8 time frame. You can see a rally, a base, and then a rally to the upside. Let's just bring it back to the D1 time frame, the daily time frame. You can see a rally, a base, and then a rally. This base sponsored this rally that took out all this relative equal highs. You see price took out all this relative equal highs, took them out, and then price retraced back to the downside. You can see when price came, this base structure point sponsored this move that raided this relative equal highs and also broke structure. Now you see price came back, gave us an inducement. This is an inducement. This is an inducement because this price did not fully come into the base zone that broke the structure. If you can remember, I said this is it. You have a rally, a base, a rally, then it should drop back to the base and then push price to the upside. So you can see now price came into that base point. You can see a hanging man candle here, showing us that there is pool of buyers here pushing price to the upside. There are orders here. Institutions place their orders here. It came back, retested this point, and then look at the way it pushed price to the upside massively. So price moved to the upside, came back, grabbed this liquidity here, dropped, and then push price to the upside. And then we also have another break of structure at this point. We also have another break of structure at this point, and here is the other block that led to the break of that structure. Now you can see price broke structure to the upside, came back. This also is an inducement. This is an inducement. It is an inducement, a liquidity pool, whereby price broke. This is what retail traders will say. Retail traders will say, okay, price have broke this place. They will mark it as a zone. They will mark it as a zone. They will mark it as a zone and say, okay, this is now a resistance, a support, resistance turn support. But what happened is this price failed to return. It failed to return to the demand that broke this point. It failed to return to that demand that broke this structure point. So this is considered, based on supply and demand, as FTR, failed to return. So you can see now, and then you can see in confluence to that, you have a fair value gap here, an imbalance in price. Price is not well filled here. You can see a wick here, then you can see a candle space. This wick supposed to come and align with this wick by this side to close up price space here. So price did not do that, and then price came back to this place, did not fully come back to mitigate the demand that broke structure. So this is considered as an inducement. It is considered as an inducement. Just you can see it here. Price came, dropped to the downside, broke structure here, came back, did not come back to the demand. Price came up, and then price drop, took out the liquidity here because retail traders will be okay, resistance turn supports, and then they will place their orders here and then place their stop loss likely below here, and then what, it will come, raid it, and then push price to the upside. That was what happened here. So you won't really consider this as a structure point, but it is this structure point that sponsored this entire move to this upside, meaning here is just a liquidity. We are now anticipating what, the pullback to this demand and then push price to the upside. So, and then when price came down, price grabbed the liquidity, filled up, price grabbed the liquidity and then filled up this fair value gap, came, tapped into the demand and then pushed price to the what, upside, and then price moved to the upside. So this is now our high point. This is now our high, our higher high, and then this our higher low, and then this our higher low, meaning now our range is now from here to here. Now you can see when price now came, price raided this place on the weekly time frame, raided this high, grabbed liquidity, and then you see price dropping to the downside. Price is now dropping to the downside, now reacting again. You see it did not retest the 50% of this demand. Price did not retest the 50% of this demand zone when it first returned to it, and then now you can see now price drop back to the downside and retested the 50% of that demand zone, and then you can see price reacting, pushing to the upside. So if price should break this place, if price should break our previous higher low points or our higher low points, then we can see price have turned, then we can see that okay, we are likely to have a bearish market move. If price should break it, then we can say we should have a bearish move. We should have possibly volatility turning bearish, volatility 75 turning bearish, or price will just come. You can see there is an FVG here, there is an FVG here, fair value gap here, there is a fair value gap here, or price will just come, react to it, and then push to the words upside. So let's now go to the detailed case study that was marked up. Now you can see everything that was explained. A break of structure here, price return, there is a stop hunt here, grab of liquidity, price moved to the upside, came back, we have a what, fair value gap here, plus an optimum trade entry, plus a breaker block. This is our breaker block, a fair value gap here. You can see price reacted to it in confluence to the breaker block, and then we see price push to the upside, grabbed all these equal highs, broke structure, price returned back into a weekly hiding base, what Mercury called the double marabuzu. And when you drop down to the lower time frame, you'll find an order block here, and then you find price transition to the upside. Now you can see this is a resistance, support. I seen it. So the retail trader will be like, oh, this is a strong support, so price just go up to the upside, go on to the upside. But you can see what happened. Price, there is a fair value gap here that price didn't feel, imbalance in price action, so price had to drop to the downside to mitigate the demand that sponsored the move down to this upside. So this really, it's not our structure point, this is not, meaning this entire move is our structure, meaning our higher high, higher low, higher high, higher low, higher high, higher low, higher high, then this becomes our higher low. So price can fill up the fair value gap here. Now when you see here, we have this demand sponsored this move that broke this swing point. Price came, reacted to it, pushed to the upside, and then price drop. We had a change of character here. When you drop to the daily time frame, you see it as what? A change in what? Market character. A change in character. Started dropping, forming what? Bullish structure points, sorry, bearish structure points. Actually the change in character from the daily started from here. We had a change of character from here. This is the move, a drop, base drop. So price came, reacted here, drop, change of character from the daily time frame. This is an inducement. Price went back up, came back. We have our change of character from the weekly points of view. So you can see what happened here, change of character, and then this becomes the order block that sponsored the move to the downside, here, grabbing this liquidity here, sponsored the move that grabbed this liquidity. You can see this candle came, grabbed the liquidity and pushed to the upside. So price returned to retest the sponsorship candle that sponsored the move that grabbed the liquidity here, You can see this is the candle here that grabbed the liquidity here. So price went back, retested it, and then moved to the downside to mitigate this demand. And then we can see that this candle grabbed this liquidity and then pushed to the upside, creating a change of structure here on a lower time frame, because this will be forming a bullish structure on a lower time frame. And you can see then price dropped to the downside. You have liquidity pools here, and then a fair value gap here. Price moved to the downside to mitigate this. This is a pin engulf. This pin engulfed this pin. When you drop down to the time frame, lower time frame on the D1, you find an order block here. So price came to mitigate it. This candle grabbed this liquidity, sponsored the move also that cleared this point, grabbed liquidity at this point and this point also. So price came, fill up the fair value gap, and then push price to the upside. Now on the daily, you would see that within this candle I found a strong high. This is a strong high because this high sponsored the move that broke this, that grabbed this liquidity, also grabbed this liquidity here. This is a weak low because it couldn't take off this high. So this is a strong high because it grabbed this liquidity, broke this structure here, caused a change in character, and also grabbed the liquidity here. So you see price came. So I was like, okay, price should come. Price reacted at this OB, which is in line with the strong high. This OB now sponsored more the movement that cleared this. This is now an inducement. It is an inducement. Just like, okay, a break, price coming to retest. This also is an inducement, a break, a retest. So it couldn't hold price. So price came and took it out, dropped the liquidity, came here, dropped to the downside. Then price came and then rate this high and then started dropping to the downside. So basically this is just what I want us to understand in this. So I'll make the image available for your study in the Telegram channel, so do well to follow the Telegram channel. Cheers.